Morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities. Welcome to Monday Minutes. Brief look back to last week. A lot of Fed speak before the Fed's blackout period, which we have another Fed meeting, obviously, next week. Speech by Fed Governor Brainard. We had a speech by the head of the Fed SOMA account, Lori Logan, talking about market liquidity and measures taken to date. We also had a lot of Fed speak around the Fed's framework and a pathway forward. There is certainly a growing sense from the Fed, a growing concern from the Fed in terms of the reopening of the economy, the growing number of coronavirus cases. Obviously, Congress back in focus today. The Fed has certainly pushed back on the inflation side of the mandate. We have a white paper that we put out on Friday, which talks about negative interest rates and the Fed's potential next move in light of what we've been hearing from them as of late. But all eyes continue to focus on the inflation side of the equation. You look at the speech by Brainard, and you do get a sense of stabilization in the market, which is consistent with the comments from Lori Logan. You look at the Fed's balance sheet to date, you look at the lending programs, which have largely been untapped. The expansion of the balance sheet has really come mainly from the purchases of treasuries and mortgage-backed securities in conjunction with the international swap lines. Obviously, with the funding pressures that we saw in March in the dollar funding market, those swap lines now have been gradually rolling off and coming down. So the balance sheet has actually trickled a little bit lower with the exception of this week. We saw the first increase in the balance sheet in the last 4 weeks. But the majority of the balance sheet growth has really been in treasury and mortgage-backed security purchases for the stabilization of that market with the dislocations that we saw in February and March. So take that into context, look at the fiscal side of the equation. You look at the expansion of the Fed's balance sheet, $3 trillion. You look at the lending programs from the first CARES Act, which are worth $4 trillion in overall totality in terms of what they can use. Obviously, right now they have a little over $2 trillion available. And then you look at the fiscal side of the equation, and we have another $3 trillion before the potential CARES Act 2, which will be hashed out over the next 2 to 3 weeks. So we have $10 trillion in liquidity pointed at this economy right now. And the reality is the Fed is positioning themselves here, we believe, for more, not less. It's unlikely to come at next week's meeting, given the fiscal side of the equation. Like I said, the Fed has pushed back on the fiscal side of the equation. In our white paper this week, in our weekly, we certainly think it's prudent for the Fed here to take a little bit of a pause. When you look at the Treasury market, there has been a stabilization in that market. There's a lot of liquidity in the marketplace. Obviously, the facilities that were put in place to alleviate conditions in terms of money markets has gone a long way to stabilizing those markets as well. So we do think the next move here is on the fiscal side. We will see how that hashes out over the next 2 to 3 weeks. But obviously, when you look at risk assets, we're still trading with the sentiment that right now liquidity is driving the equation. We look at the growing number of coronavirus cases. We look at the concern over the reopening. We've been steadfast in our view in terms of we think this reopening will be very uneven going forward, mainly off the back of the fact that we really don't have our hands fully around how this virus is being transmitted. Obviously, the growing cases now in the United States, but also on a global basis here has the overall sentiment in the market now is one of concern. Having said that, if you do look at risk assets, we still trade with a fairly firm tone. And we think the bulk of that is really off the back of the fact that there is still a lot of liquidity in the system. The bulk of that obviously coming from the monetary side, but there is an expectation, despite the acrimony and differences that we're seeing in Washington, there certainly is an expectation that both sides have an incentive here to come together and get something done in the next 2 to 3 weeks. In terms of data this week, very light week. We have the claims number on Thursday, which we think obviously has been front and center. We think the employment picture here obviously is critical, but in light of the growing number of coronavirus cases, we do think the claims number will be watched very closely here this week. In terms of Treasury supply, the Treasury's general account at all-time highs. We continue to get short-end supply. In addition to that, we get 20-year reopening this week. We also get 10-year tips. And keep in mind, when you look at real yields, you look at the real yield market, you look at gold, real yields in the United States now are roughly negative 85 basis points. You look at gold, there is a growing sense in terms of the economy here as we move into the second half of 2020. I am Greg Faranello, and this is Monday Minutes.